Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address.
You are listening to an entertainment program put together by a company called Financial and Entrepreneurship. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Hello everybody and welcome back to the China Shop. Joining me today is a very special guest. We have the shrewd and Shakespearean Shawn O'Malley, the chief editor and financial writer for the Investors Podcast Network. If you'd like to learn more about today's guest, go visit theinvestorspodcast.com/newsletter, where Shawn and his team post market-related content daily, not to mention the many great podcasts their networks partner with. Lastly, please feel free to reach out with suggestions, corrections, or questions for future guests. You do that via email at twobulls@financialandaptitude.com, or you can join our free Discord server where a bunch of amazing people gather to share our struggles and lessons learned with other like-minded market aficionados. I'll have all those links in the episode description so you can peruse them at your convenience. Without any further ado, welcome to the shop, Shawn. How are you doing today?
Hey, thanks for having me on, Kyle. It's absolute pleasure and very, very nice intro. I'm happy to dive into things today.
Yeah, the Shakespearean, did that fit? That writer, like that might be a nice complimentary one for you.
No, I appreciate it. Yeah, I've never thought of it that way. But, when you work on writing a newsletter every day for over a year now, you definitely are putting out a lot of writing.
We'll have to dive into some more of that because I've been looking through some of the content you guys have put through there, and there's a lot of great just conversation starters, if nothing else.
Yeah. We, try to keep people well informed. And, there's a lot of newsletters out there that are just pop culture and news focused or, not really written from the perspective of like really serious investors. And so we have this backdrop of, having the world's largest stock investing podcast. And we wanted to go into making a newsletter that is, serious about investing and also contextualizing things for people and helping them understand what's going on in current events. So.
Yeah, and I love that there's no none of those. If you invested $1,000 in Apple, here's what you're stuck. Yeah, like I hate those types of clicky headlines. I don't see any of that on there.
Yeah, I hate clickbaity stuff too, and so I think maybe that influence has kind of trickled into the newsletter a little bit, or like here are my top 5 stock picks of the month.
Right? Yeah.
Stuff like that. It's kind of garbage.
Yeah, the listicles, right?
Yeah, exactly. Yeah.
Well, how'd you get involved with the Investors Network?
Yeah, it's an interesting story. It feels like my life did this huge 180 pivot about a year and a half ago. So, it started out with I began following the Investors Podcast actually during the COVID 2020 lockdowns. So, it's this moment where I'd actually been traveling, as a bit of a tangent here. I'd actually been traveling in Southeast Asia in December of 2019.
Oh, really?
And so I saw the early kind of COVID outbreak warnings, moving into January 2020. And so I came back to the US and I kind of had this eerie feeling that like things like the world was changing and I didn't understand how yet. And so, flash forward a little bit, the whole world's on pause, schools are shut down, everybody's, working remotely as best as possible. And so I just made a really conscious effort of, okay, I don't know how long these lockdowns are going to last, but I'm not going to use this time just like playing video games and wasting my life away or, just listening to music, whatever. Right. Like I'm really going to try to like productively learn something. So it's so funny. I opened, a Spotify app and I just searched investing podcasts. It's like, okay, I'm familiar with investing. I studied finance. but I'm not really super into, tracking the markets and picking stocks and
Mm-hmm.
stuff like that. And the first one that pops up is the Investors Podcast Network. And then the flagship show is called We Study Billionaires. And I open it up and they're talking about, just tracking Warren Buffett and principles of value investing and stuff that, they're not really covering on, let's say, CNBC or like the kind of mainstream financial news, to really
Mm-hmm.
sit down and talk about, okay, what is intrinsic value? Or, what are the biggest takeaways from, Berkshire shareholder meeting at Omaha, which is actually, I think, the first episode I listened to.
Yeah.
So yeah, I fell in love with the podcast and I was listening every day and I probably binge listened to hundreds of their episodes and did the courses and got, fully ensconced in the sort of ecosystem of, not just the Investors Podcast, but also stock investing again, generally. And so, flash forward, I'm at this point, I'm working at S&P Global as basically,
Oh, wow.
working in data and their financial markets platform, very mainstream finance job. I'm passing, I'm working the CFA and I passed level 1. And so I'm doing all the like classic finance stuff, working for a big company,
Mm-hmm.
getting my certifications. And, I'm still listening to the podcast on the weekends and I'm, just realizing that my passion is for, stock investing and podcasting and sort of educating people about investing in finance, as opposed to, working in the trenches of the financial system and working with investment bankers and stuff like that. And, helping the rich get richer, so to speak.
Right.
It was not really my passion and what I necessarily wanted to do for the rest of my life. And so I saw this, or I heard this ad on one of our now that I work for the company, but one of the Investors Podcast shows, I heard this ad for a YouTube host. And it's so funny. I was like, okay, I know nothing about YouTube. I don't think I have the face for YouTube. I don't think I have the personality for YouTube. I don't, part of my maybe, let's say, finance ego is like YouTube. Like, oh my God, no, like I'm a serious investor. Like I can't be doing stuff on YouTube. But I also realized like, hey, this is so cool. This would be my dream company to work for. If this is what gets me in the door, of course I'll do, YouTube content. Sure. And so, I send out this application and basically, part of one of the questions was, what would be your plan to grow our YouTube channel to producing $1 million in revenue a year? I had no idea. I looked back at what I wrote the other day and it was just total nonsense and gibberish. But, our company's founder, his name's Stig Brodersen. And so he actually, I think he saw my application. And I think what stood out to him was I listed all of these books that I read. And he's an avid reader, and he's formerly a professor, and he's a co-host of our main show, We Study Billionaires, and all that good stuff. And so he appreciates a good reader, and I think he was willing to meet with me because I'd read all these books, and kind of funny enough, the reason the books that I had read appealed to him because they were all the books that he and his co-host had recommended from the last 2 years of the podcast. So basically, every time they recommended a book, I would just sit down and read it. And then I had this huge library of books I've read. And I was basically like, yeah, I read The Price of Tomorrow and Black Swan and, all these, kind of interesting books. And he was like, okay, I'll give you a meeting. And so, funny enough, we do the meeting and I actually bombed it. I made a terrible first impression.
Oh, no.
And I was doing the classic, like interviewing like I was interviewing for a job on Wall Street, like wearing a suit, just being super artificial, and and he was basically like, I think 19 minutes into the interview, he just kind of looks at me and he goes like, hey, I have no idea who you are right now. Like this is, I thought you were going to be this really genuine and interesting guy, and you coming off and like this is all plastic and fake. Like who are you really? And so we actually ended up having more of like a heart-to-heart conversation after that. And he sort of gave me this second chance. And admittedly, I was starstruck because I'd been listening to this guy on his podcast every week for 2 years.
Right.
And all of a sudden, I'm meeting him in person. And I've been so practiced in like traditional job interviews. And so I totally botched it to kick off. But he gave me a second chance. We had a heart-to-heart. And he basically goes, he's like, look, I don't think you're the right hire right now. You don't have any background in YouTube or anything like that, but I like you and I want to keep in touch. And so I thought that was just kind of a really nice way of him telling me no. And I was like, okay, you know what? At least I redeemed myself a little bit. But I've probably wasted away this opportunity. And then,
That sounds to me like you didn't bomb it. I mean, he wouldn't have given you the second opportunity if there wasn't something in there that he
Yeah,
like.
I think maybe it was the reading list. I think that falling back on that is
Yeah.
really maybe what saved me. And so, yeah, then a couple months after that, he reaches out to me and he goes, would you be willing to write like a stock investing guide? Just, put together a long article, 15, 20 pages. We'll pay you, a couple $100, whatever it was. And just kind of a freelance thing. Just really looking back, it was obviously just a test of my skills
Yeah.
and
Yep.
capabilities. But I thought it was the biggest honor of the world. I was like, yeah, I'm going to write this article. And I think I poured my soul into it and like dozens and dozens of hours of research and writing and editing. And so I put together this final write up. And I think he obviously was reasonably impressed enough to hire me. And he goes, look, we're looking to start a newsletter. We have this email base that we've been accruing over the years from the podcast, but we're not really doing anything with it. And I'd love to have you help with it. So that's where I got brought on, was to basically kickstart our newsletter.
Man, that's like, what's it like when you actually do land your dream job? Like, is there like a lot of pressure that comes with it? Like,
There is
are
a
you
lot of
just,
pressure. There is a lot of pressure because every day, I'm not going to pretend like every day is some amazing day where I wake up and I go, oh my God, I'm working my dream job. I mean, sometimes I take a deep breath and you look around and you realize like, okay, this is really cool to be doing what I'm doing. But there are also these moments where, you're really stressed, you're really overwhelmed, you're really frustrated and stuff like that. And so when you set these crazy high expectations for yourself of like, I'm working my dream job, why
Mhm.
is this, why is my, why am I not the happiest I've ever been? Or why are things not, perfect in every other aspect of my life? So, I think there's been an adjustment period to that of where, not to say that it hasn't lived up to my expectations, but it's still, a job is a job, right? And it's a lot of work. And even your dream job
Yeah,
is still going to be difficult and challenging and push you in new directions and beat you down at times. And, honestly, if it didn't do that, then it would be a terrible dream job because you're not improving.
exactly. Like a good job, those you have those moments, I think, where you are challenged and tested, but it's the feeling after you've passed those challenges. Like if you get that sense of accomplishment, and you can look back on it and think like, ah, yeah, that was trying, but guess what? I knocked it out of the park. Like though that feeling, I think, is one of the best feelings in the world.
Yeah, yeah, I think that's exactly right. So, I've had the opportunity to work on a number of projects with the Investors Podcast Network at this point, and so, some have gone well and some haven't. But one of our mottos is really kind of this idea of continuous learning. And it
Hmm.
sounds very cliche, but I think it is sort of a profound insight of, of course, everyone's familiar with compounding investing, but this idea of compounding your learning and, 30 minutes of deep learning or an hour of deep learning a day where you're just sitting down and you're reading a great book written by a legendary investor or philosopher, somebody just really insightful, and you're sitting down and really absorbing some amount of knowledge. I think doing that kind of thing, really compounds over time. And then, the other way to compound your learning is obviously, learning from failure.
Hmm.
So, like I said, we've done a number of things that have not worked out well at all. And it's never, oh, this is a waste of money. This is a waste of time. Sort of starting at the top with our co-founders, their outlook is basically, okay, it's okay to fail, but what's not okay is to fail and not learn anything from it. And so,
Hmm.
whenever things don't work out, it's always a question of, okay, what can we do different next time? Or, what did we do wrong? Instead of just letting a failure happen and not using it as a moment for some sort of improvement.
Yeah, and we've been big on that, especially with our like what we've been learning is trying to learn how to be good traders. Like you have a bad day, well, you didn't fail unless you didn't take the lessons from it. Like that's our outlook here.
Yeah, that's exactly right. I mean, honestly, where I first heard that from was, I think, Ray Dalio's book,
Hmm.
Principles. And yeah, obviously he's got a track record that speaks for itself. But he's no he's really one of the biggest advocates for this idea. I think he has a quote. What is it? Um, Pain plus reflection equals improvement, something like that. And that perfectly captures it. Yeah.
Yes. You mentioned a massive reading list that you went through, and with the when you started diving into We Study Billionaires. Like, what are some of the favorite books that you did pick up?
Oh man, there's so many.
Give me your top five in list form. No, I'm just kidding.
I'm looking around. I've got a bunch of them around me. Influence by Robert Cialdini. That's a great book for understanding. It's one of those that Warren Buffett and Charlie Munger recommend and sell every year at their their shareholder meeting in Omaha.
Hmm.
I would say that's such a great one for understanding, psychological biases that affect you, and also kind of almost learning to see the world through the eyes of a salesman,
Mm-hmm.
and realizing the many small ways that people are trying to subtly exploit you.
Oh, that sounds like a fascinating book. What, Robert Gallio, you said?
Robert Cialdini, and the book's called Influence: The Psychology of Persuasion. It's a great one. I've got it on my desk right now. Over 5 million copies sold. Actually, there's a quote on the cover from Charlie Munger. This is the book that I give most often as a present and is my top recommendation.
Oh.
So that's big praise from Charlie Munger.
Yeah, I'll be picking that one up. I can't believe I haven't run across that one.
Yeah, no, it's a great one.
One of my personal favorites has been Blink by Malcolm Gladwell. And it's not
Okay, yeah.
necessarily a market related book, but I thought it was just a fascinating look at understanding like the power of the quick decisions. Like if you can actually learn to like really understand how those decisions are made, and the idea of like less is more when it comes to analysis. Like find the three big things that really matter and forget about the 50 other little ones that don't mean anything.
Right. Yeah. I think, honestly, from my take on what I've seen in the financial world thus far, the people who do the best are the most well-rounded
Mhm.
individuals. It's not the person who sits and studies charts and only finance all day, every single
Right.
day, right? It's these people that have sort of interdisciplinary skill sets that they bring into investing and trading and finance. So I feel that these sometimes non-market related books like Influence, which
Mhm.
actually about human psychology or history, stuff like that, are actually some of the most insightful. And I know for our company, I think is it? Oh, I have to look it up. Is it Happiness by Tony Hsieh? Yeah, it's Delivering Happiness by Tony Hsieh. Yeah, and that's another great book I'd recommend to people. And it's not a markets related book at all, but it's really he started Zappos, and it's his story of how he built that company and what it was like to basically watch it grow and then become this foreign thing where he hired hundreds of employees, and he went from having this small culture of he knew everyone in the office to one day he walked out of his office and he didn't recognize any of the people around him and know
Right.
their names. And so basically his learning lesson was, okay, how can I build a company that's optimized for happiness and not necessarily optimized for profits and growth. So that's another book that's really kind of shaped
Hmm.
how our company, the Investors Podcast, has been built and set up. We could have grown a lot quicker. We have around 30 employees right now. We could easily have 50 or 100 if we wanted to take on debt and invest a ton of money and hire a bunch of people. But we've really focused on this idea of optimizing for happiness and thinking about what it means at every level of the company, and for all the different sort of people involved with it, and the people that the lives we touch, let's say, by the people who are
Mhm.
listening to the podcast or reading the newsletter, all the way up to our CEO and our different podcast hosts of, what does it mean on a day-to-day basis to optimize for happiness. So those would be my two book recommendations: Delivering Happiness by Tony Hsieh, and then Influence by Robert Cialdini.
Okay, I'll make sure to put those in the episode description because I'll probably be picking up a copy as soon as we hang up this call. I also love what you said too about the not growing too quickly, because I think it's something that happens a lot in the corporate world. I think it happened a lot with Nucor when I was working with them about 10 years ago. They just expanded way too quickly and didn't have the talent base internally in order to be able to fill those roles and maintain their culture. And
Yeah.
I think there's a real danger to growing too quickly where you lose that thing that made you successful.
Yeah, it's a very counterintuitive
Hmm.
problem, because if you went to, a bunch of MBAs in business school and said, what is the goal of a business? Okay, it's to grow.
Hmm.
Yeah, right. Okay, so let's grow at, whatever is possible to grow as much as possible and maximize for profits. But like you said, you can really risk diluting your culture and, some of the other intangibles that make your business work if you have undisciplined growth.
Right.
So, a lot of great companies have been very disciplined about how they've grown, from Amazon to Netflix. Not that anyone should aspire to recreate what they've recreated, because, the odds of doing that are,
Right.
basically impossible. But it doesn't mean that the takeaways can't be applicable to, your small business with 3 employees, or our company with, around 30 employees. And that idea of really disciplined growth of, how can we scale responsibly? How can we find people who are, for example, great people managers to manage other people, and not just appoint somebody to manage people. You know what I
Right.
mean? Like
Yeah.
you see that a lot at companies that grow really quickly, and it's like, okay, we're going to hire this person for this role, and then they're going to have two people that report to them with no consideration for, okay, how is that team actually going to work? How, are the values of this company going to translate through the work that they do on a daily basis? And what sort of ultimate aim are they working to achieve beyond just, growth for the sake of growth,
Yeah.
right? So I think it's all too common, but it's something we try to be really mindful of.
It's almost like the movie Big is like a perfect example of that, right? Like it's the
Yeah.
same thing. Like you
Yeah.
take a kid and put him in a 30-year-old's body. He doesn't have any of the experience that comes with, the 30 years that would be in between that he skipped. Like a company goes from a small cap to a large cap overnight. Like they are missing a lot of experience that comes along with that journey.
Yeah, that's a great way to put it. And I mean, we're talking now, right? Basically, when I think WeWork just did a 40-to-1 reverse share split or whatever it was, because the company has destroyed, $47 billion of market value in the last how many ever years it's been.
Right.
And that's a great example. And it's so counter to, really, I mean, this would be like blasphemous stuff to say in the Silicon
Oh
Valley
yeah.
sort of ecosystem, where it is really just growth for the sake of growth, soak up as much market share as possible. And, it doesn't matter if you're losing money, investors are going to subsidize that. Well, that model doesn't work when there's actually a real sort of economic cost of capital that imposes constraints on your funding, and you can't just burn cash
Right.
forever and grow in this, really undisciplined manner.
Yep. I want to pivot real quick. I listened to you on Andrew Stoltz talking about your worst investment ever, and I was curious what some of the lessons that you learned from that. I think it was a Russian ETF that you invested in right before the Ukraine war.
Yeah. Talk about an eye-opening experience. I will qualify and say maybe not right before the Ukraine war,
Yes,
because
yes.
that was a particularly perilous time to have made that investment. But I mean, the original thesis was like in 2020.
It was a good thesis.
Yeah. It was actually, I think I made the investment right when oil futures went negative,
Right.
and there, for like 2 seconds, oil prices were negative, and it was a big news story. I was so super naive about investing, and I sure still am now, but I've definitely learned a little bit since. But at the time, I, had this sort of, I guess, correct insight of, okay, this is obviously not sustainable.
Right.
I don't really know why energy prices are negative. I could, come up with some reason because of the pandemic and, crushed demand and all that stuff. But, whatever it is, it's really irrational for, energy prices to be negative. That's not sustainable.
It was such a weird thing. I think it had to do with the fact there's no storage, right? Because those futures contracts, you
Yes.
have to take the oil delivery, and nobody had a place to put it.
That's right. Yeah, there was a storage glut, but whatever.
Yeah,
I digress. And really, the point was that I had this insight of, okay, this is probably a good time. There's a lot of fear in the market. There's blood in the streets. People are really worried about the economy, and it's manifesting in oil prices. So how can I bet on oil? And I made some obvious bets, like betting on like Marathon stock, or companies in the U.S. that are more directly going to benefit from, let's say, a rise in energy prices in the next couple of years as the economy reopens
Right.
and stuff. So there's sort of this multi-year horizon investment of like, okay, this is probably the bottom, and how can I position myself to benefit from rising oil prices over the next 2 or 3 years. And then the other way I thought about it was I was looking at these Russian oil and gas stocks, and they're paying 7% dividend yields. They're trading at like a price to earnings ratio of 8.5, unbelievably cheap. And as a naive young man, kind of new to the world of finance and investing, this idea of geopolitical risk was so foreign to me. I couldn't understand it. Why would you pay a premium for an oil and gas company in the U.S. that's 2 or 3 times, the PE ratio that you would pay for the same, the same amount of earnings, let's say, in Russia?
Yeah.
And I could kind of understand it, like, okay, yeah, there's some risk in Russia, but I grew up in a relatively stable time in world history,
Yeah.
right? And so, this idea of like, okay, well, Russia's not going to invade another country. Russia's not going to invade Ukraine, which obviously, if I'd just been a better student of history, I could have seen what happened in Crimea in 2014, and then probably many times before that.
Yeah.
Right. Yeah. So, yeah, maybe the world we grew up in, or I grew up in, wasn't as stable as I thought it was.
Yeah.
But I certainly didn't have an appreciation for what it meant to have geopolitical risk, and even what it meant to invest in different countries. It's probably a very American-centric bias to just think that the world works in the same way that things work in North America and
Right.
probably Western Europe. And that's just not the
No.
reality. So, yeah, I bought this Russian ETF. I think it was ticker ERUS. And I bought that in 2020 as sort of a portfolio of different things that I was betting on to benefit from, an eventual recovery from COVID and a rise in energy prices over the next couple of years. And so, as we're heading into, right before Russia's invasion of Ukraine in 2022, now I'm like a year and a half into the investment or something like that. And I'm just thinking, okay, there's no way. Like this is one of those moments where, in the same way that I started this investment thesis when people were panicking about oil prices, this is another opportunity. People are kind of falsely panicking about something that's never going to happen. And I just totally dismissed the possibility of a ground war in Europe. Yeah. And, of course, the invasion happened. The same, and the money I lost is by no means the worst consequence of, the terrible stuff that's been going on there. But, it did have a very, very good, learning lesson moment for me, where I saw basically the value of my investment go to zero almost overnight because of these sanctions that were imposed on. You basically Americans can't own financial assets in Russia. So it actually became illegal to own Russian stocks.
Oh, that's right.
So, the picks that I had made in theory were, maybe good bets, right? They had low PE ratios. They're churning off, huge free cash flows. Energy prices had, doubled or tripled since I made the original investment. But, despite being maybe directionally correct, this basically technical nuance of the U.S. sanctions that went on to Russia after the invasion made the investment, go to zero. And it's one thing, to be like, okay, you're wrong, and we lost 20%. It's like, no, this went from 100 to zero basically immediately. And I think a couple months ago, I got the last. There was some cash and so some of the stuff that they could salvage that was remaining in the ETF, they basically distributed out to everybody. So I think I got like 1 cent per share back.
Oh, ouch.
So like I think there are a few times when people truly get zeroed out on an investment, unless you're doing something with options.
Yeah.
I mean, for the most part, like stocks don't, maybe a 90% drawdown, sure, maybe, but you don't get a 99.99% drawdown all that often. But yeah, I live that.
Especially in an ETF.
Right. Especially in an ETF where you're told that, you're taking, I thought I was so savvy, I was like, I'm taking this diversification, I'm not, making idiosyncratic bets. I'm just going to basically try to benefit from the whole sector in this region of the world. And, I thought it was such a savvy thing to do. And I totally underestimated what I didn't know, which I think, is a great lesson applicable to anyone in financial markets. Never overstate your understanding, especially when you're talking about things at a geopolitical level.
Right.
Very, very naive.
Oh, God,
very naive for me to. It felt like I had a good grasp on the risks that I was actually taking. And I would have told you, well, look at how it's returned over the last decade, and blah 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 stuff about stock investing long term and the energy sector as an inflation hedge, and whatever kind of nonsense I would have probably choked out. But the reality was I was taking risks that I didn't even understand I was taking. And those proved to be black swan risks that totally wiped me out. Yeah, I was playing literally Russian roulette with that part of my portfolio. And I didn't get lucky. So yeah.
Have you ever heard of Bill Browder?
No, I'm not familiar with him.
I just ran across an episode he did with Jordan Harbinger on his podcast, talking about, he's a big investor. He's one of the first people to really start investing heavily in Russia. And some of the stuff that he talked about with like how they do things over there was just mind boggling. Yeah. Like you sign up for like these little vouchers, things that they give you, and then you take those, and that's how you like purchase your shares. And if you're the only one who applies for shares of
whatever company, then you get it. Like there's
Yeah.
no, it's all determined based on who wants to redeem their certificates. And most people pick like things like their cars or like the brands they recognize. So you have this weird scenario in Russia where like all these major cash cows are undervalued because nobody's heard of them. But then they do all these other weird shit. Like they'll make the meetings in like Siberia, and then the guy who runs the company like shuts down all the flights into there so nobody else can go and challenge his stock purchases.
Oh my gosh, I'll have to check out his stuff. That sounds interesting. Yeah.
it's it's such a fascinating just listen. And yeah, so there's, when you say that most like companies don't work or countries don't run their markets the same way the US does, like yeah, 100%.
Yeah. Oh, yeah. Yeah. And again, it comes from this sort of naive place that I think you have to learn those lessons. But, when you sign into your Robinhood app or your Charles Schwab app,
Hmm.
and you just see things that are traded on the New York Stock Exchange, you just presume that there's a certain level of safety to that.
Yeah.
It's like, okay, it wouldn't trade on the New York Stock Exchange if it was this crazy risky thing to be investing in.
Right.
And it's really easy when you're just looking at 4-letter or 3-letter tickers or whatever it is on your brokerage app, and it's like, okay, Apple, Microsoft, and then Russian stocks, and they're all right there together.
Right.
It's very easy to associate those sort of give this false equivalency of how safe the investments you're making are. Just because you can trade Apple and Russian stocks in the same app does not mean that you're taking the same financial risks with those. And so, yeah, I mean, ultimately, I think it was a small lesson to learn in my investing journey.
It sounds like it's one that really stuck out though.
Yeah, and the reason it has stuck out in particular is because, as we so often do when we lose or fail, we probably overly extrapolate those concerns.
Mm.
And so, not to say that I've necessarily done that, but I've gone much deeper into studying macroeconomics and geopolitics and trying to understand, okay, what the heck is actually going on in the world, and what were a lot of these obvious factors at play that I totally overlooked, and maybe how should that reshape my investing portfolio. And one of the areas that I've maybe in some people's eyes you would say I've overcorrected, in my eyes I feel comfortable with the way I've changed things up, but I've basically removed all investments in China
Hmm.
out of my portfolio.
I've done
And
that too.
it's a controversial one, right?
Mhm.
And but the reality is that that Russia's invasion of Ukraine was a very eye-opening event for me. And like I said, it drew my mind to geopolitical risks that were unfathomable to me before.
Mhm.
Um, and obviously, without going into too much detail, you can certainly see some parallels there with Taiwan.
Yeah.
And even the fact that foreign ownership of Chinese stocks is illegal, and that these ADRs are, kind of just this crazy proxy system that like should maybe not be allowed to trade on the New York Stock Exchange. But I don't know. I digress. But there's a lot of sketchiness when it comes to actually investing in Chinese
Oh
companies,
yeah.
whether from the actual technical ownership details to the kind of bigger picture. Will there be a Taiwan, U.S. China conflict, and what would be the ramifications of that? And the most obvious one, basically, right? We set the precedent with what we did with Russia.
Yeah.
You can imagine there would be a whole lot of financial sanctions at a minimum if you see any kind of sort of serious escalation with Taiwan. So yeah, I don't know. That was a good learning lesson, and I was very committed to not making the same mistake again with authoritarian regimes set on restoring ancient empires, as you could say.
Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address.
And
That's funny because I think the thing that scared me out of China was the whole thing that happened with Jack Ma and Alibaba and the way the Chinese government completely squashed that ant-IPO. Like seeing the government having that much influence in the day-to-day operations of a multi-billion-dollar company is like, you know what? I don't want any part of this.
Right. Yeah. The most powerful private market players in China don't hold anything to, the actual people
Yep.
kind of pulling the strings in the Communist Party. So yeah, I mean, that's one of many dozens of reasons to be cautious about investing in China. But the thing that really I found most disturbing was, again, I was following the very kind of consensus financial logic about, okay, this is how you build a globally diversified passive index fund retirement account. And I'm looking at my 401k and I'm like, okay, I'm doing the 15% in an emerging market index fund.
Mm-hmm.
And then you open that index fund and it has 40% exposure to Chinese stocks.
Yeah.
And then it's got another 15% exposure to like Taiwan. And so I'm sitting there and my jaw drops to the floor. I'm like, oh my God, 55% of my emerging market investment is exposed to a China-Taiwan conflict. That is really, really disturbing. And then I'm looking around and looking at my friends and my family at their 401ks. And I'm thinking, okay, you guys are all, we're all in these Vanguard emerging market funds, right? That's like the standard, you get a job at your 401k, you have a couple preset allocations, and then they're putting you into this huge geopolitical risk, another order of magnitude or two orders of magnitude bigger from sort of a financial market implications of what happened with Russia and Ukraine. But you're just taking that with China and Taiwan. So I've really now pivoted to trying to, if I'm going to get that emerging market focus, picking specific countries and ETFs that are, investing primarily in there, an India ETF or Colombia ETF, something that as instead of this broader emerging markets exposure where, they're ultimately they're market cap based. And of course, a lot of the largest emerging market companies are going to be based in Taiwan and China, and they just disproportionately dominate those ETFs.
So you said that you were just in Southeast Asia, like right before the COVID lockdown started hitting. Like, what countries were you visiting there? And was it just like a trip just to go explore, or were you like out there like putting boots on the ground, investigating like for diamonds in the rough kind of stuff?
Diamonds in the rough. I wish. It was actually sort of a school study abroad program, and so it was based on. We went to we went to Singapore, Malaysia, Thailand, and Vietnam. So I got a pretty broad tour of the region, and we met with hedge funds in Singapore, and we were meeting with the U.S. Embassy in Vietnam and the Chamber of Commerce. And so we get to make all kinds of incredible connections. And honestly, that is what planted the seed of wanting to be invested in emerging markets. Because I went to these countries and it's like, God, you go to Singapore and you fly back to New York, and New York looks like a third world country. I mean, it's like it's embarrassing.
Wow.
I was like really, really embarrassed to come back to the US. I was like, God, our infrastructure is terrible. And, the reality is like, because a lot of that's brand new, right? I mean, a lot of that infrastructure, those airports, those roads, I mean, a lot of that just got built in the last 2 decades.
And that's exactly what you want to see in an emerging market, in my opinion. Infrastructure and education.
Yeah. And exactly. Yeah. We went to a technical university in Vietnam, and you're meeting these incredibly smart people. And then, we sort of asked one, it was like, okay, so like, you've got, like 5 different coding languages, and, how much do you expect to make when you graduate? Mm-hmm. And it's like $15,000 a year. And that was like a huge salary.
Right.
And it's like, okay, like there's a lot of room for growth here, because people with your skill sets could, easily be making 10x that in the US or whatever. Right. And so you just realize like, oh my gosh, there's so much potential. There's so many, the demographics are so favorable. The infrastructure is being built. The technical skills are being learned. And so, yeah, it was a really impressive experience. And I kind of walked away from that thinking like, I need, the type of economic growth that's going to be transpiring in Southeast Asia over the next 4 decades
Mm-hmm.
is going to be, it has been and will continue to be probably very remarkable. And so I wanted to tap into that. And then the very disturbing reality I found was that, you have to take a lot of China exposure to do that.
Mm-hmm.
Or at least, with kind of the conventional fund, mainstream BlackRock and Vanguard emerging market funds, it's very hard to get that ex-China emerging market exposure.
Yeah, I would love to have just Vietnam. That's one of the ones that's been on my radar of countries to watch for the future.
Yeah. And if you get the chance, you should go. It is incredible.
Yeah, I'd love to go there. The pictures. I think I watched oh God, what was it? The Grand Tour. Is that the one with Jeremy Clarkson
Mm,
and Richard Hammond,
yeah.
the guys from Top Gear? Yeah, when they went to Vietnam, it was just
Yeah.
gorgeous. Oh,
It was so cool. Yeah, the food was incredible, and I mean, you go there and the dollar goes a long way. And so, besides the flight to get out there, it's very affordable place to visit
hmm
as an American. But it's just such a vibrant, young population, and you're looking around like at the city, the city landscape, and there's like dozens of cranes and construction projects going on, and you could just feel like, okay, like
something's
this
happening.
is what, yeah, like something is happening here, and how can I be a part of this, and how can I benefit from it, which is selfishly my first thought as an investor.
Right.
But
Right. Yeah, I think. Oh man, was it Harold Vanderland? I think we talked to. He works for HSBC and is head of like their Southeast Asia arm or branch or investing branch. He wrote a really interesting book on just looking at all the different countries in Southeast Asia, and Vietnam is definitely one of the ones that stuck out on my list.
yeah, yeah, for sure. And I guess I'll take this moment to say, basically, I've been talking about this ex-China exposure and
hmm
talking about my interest in emerging markets. And so, where did that kind of ultimately lead me?
Yeah.
And I'll preface this by saying I haven't made this investment yet. So I kind of pointed out more as just a novelty and not, talking about a position that I already hold.
Uh-huh.
But there's this really interesting ETF called the ticker's FRDM, and it's a Freedom, I think Freedom ETF. And basically, they, again, it sounds a little cliche, and that's obviously like a marketing thing. But basically, their approach is to, try to invest globally in emerging market funds, and then, they quote unquote freedom weight the portfolio as much as possible. So they don't invest in state-owned enterprises, they don't invest in authoritarian countries, and then they try to,
Mm.
there's some objective third-party index. I forget what it is. I don't know if it's made by the UN or something, but it's based on the relative ratings of freedom of speech, freedom of the press, rule of law, democracy, all that stuff. And so basically, the long and short of it is it's an emerging markets ETF that leans heavily into countries that have maybe what you'd say similar values or
Right.
similar political economic setups as maybe what you would expect to find in the West. And so some of those countries are like Poland. I think Chile has a large rating. Um,
Hmm.
these are countries that are very much developing rapidly, but you're not necessarily taking the same sort of
You don't have that risk.
authoritarian risk that you might, or geopolitical risk that you might be taking with, let's say, an investment in China. These are countries that a lot of the countries I think in that portfolio are very much sort of U.S. biased, maybe, not completely, but
Mhm.
they're countries that are more aligned with sort of a US worldview and maybe world order. And, not to say one way of thinking about the world is right or not, but as an American investor, which I am, that's probably a better bet
Right.
than, especially after the precedent that's been set with these Russian sanctions, where basically it's going to be illegal to invest, let's say, in countries that are, actively considered, let's say, enemies of the U.S. and its interests. And so, you can't invest in Iran, you can't invest in Russia. And if you build this list of countries that you think might go into this sort of naughty list or this sort of restricted investment list, why not try to get ahead of that?
Well, you also have to worry about it's probably less risk of nationalization too, right? Or when they like,
Exactly.
take
Yeah,
all the assets of foreign companies and make them the state owned.
that's exactly right. Yeah.
Like I think Venezuela does that a lot, don't they?
Yeah. I mean, that's right. And, other things like currency devaluation,
Yeah.
inflation.
Yep.
I mean, there's a lot of, other sort of extraneous risks that you can sort of control for by just focusing on stable countries with rule of law and freedom of the press and freedom of speech and stuff like that. And, from risks of terrorism to war, I mean, you can really kind of trim a lot of that out of your portfolio. So I don't know, not to make this sound like an advertisement for that, for
Right.
that
Right.
ETF, because I'm not associated with them in any way. And like I said, I'm not even invested in their fund, but I just thought that was such a novel way to maybe think about emerging markets investing. And it strikes me as a very smart way to do it. And maybe it's something I'd love to just try to recreate on my own without, paying the management fees of their fund or whatever. But yeah, I don't know. It's really interesting.
It almost falls under ethical investing, but what you just described sounds a lot like the way ethical investing I think should be. Like I like it when the ethics and the values and the things that I look for like align.
Right. And so it's kind of, I mean, it's like the promise of ESG investing, but in reality, a lot of ESG investments,
Right.
you know, underperform
Mm-hmm.
kind of structurally. Whereas, this is sort of like a Warren Buffett expression, but it's it's actually better to do good business and be ethical than it isn't, right?
Yeah.
Like there's an intangible value to building trust and honesty and having stability. And so, that equates to, whether it's running a business and sort of the Warren Buffett model of being this folksy, really highly trustable person with a whole lot of corporate stability, or whether it's with a country where you have there's a lot of trust in the institutions. And it's a very stable sort of geopolitical environment, stable rule of law.
Mm-hmm.
That translates to actually higher returns on investing over time. And you can have a country that's growing, erratically, but that doesn't necessarily translate to, great investment returns over time, especially if, like you mentioned, that's going to ultimately result to in a regime change and a
Right.
coup, and then all the country's assets get nationalized. That's you're going to get wiped out,
Yes.
and you're playing Russian roulette with your investments to an extent. And maybe on average, it's like, well, on average, investing in Russia, you get an 8% return a year, and it's like, okay, that's great. But once every 20 years, if you get zeroed out, you're just waiting to get zeroed
Yes.
out.
Yes.
Right. Yeah. And so, I mean, you got to stay in the game to keep playing the game, which is such a, silly thing to say. But basically, I mean, what that translates to is you can't get wiped out, and you should avoid places where you can get wiped out. And that's really the very basic thesis of, let's say, this freedom weighted style of investing, where you're saying, where are the places. It's sort of a via negativa approach, I think, as Nassim Taleb would say, not trying to, or as Charlie Munger would say, sort of inverting the problem, not figuring out where to invest, but figuring out where not to
Right. Right.
invest
Right.
is a great place to start.
Yeah. Oh, I like that. Talked a lot about China, and I had a bunch of other topics on here, but I don't know that we're going to be able to get to because I kind of want to get your thoughts on what's going on in China with the real estate crash and Evergrande declaring bankruptcy, Country Garden not paying its bills.
Yeah. Yeah. And that's a story. I mean, I've been tracking for a
Hmm.
while,
Yeah,
obviously.
we've been tracking Evergrande for about 2 years now, I think.
Yeah. And so, I was thinking about this the other day because, actually before Country Garden and Evergrande kind of came back in the news the way they have been
Hmm.
the last couple of weeks, let's say a few months ago, I was asking myself, I was like, okay, what can I learn from the fact that there was all this hype about how Evergrande was going to bring down the Chinese economy,
Right.
right? And it was going to destroy things. And then I was thinking, like, okay, what does that mean? The fact that hasn't happened yet? Like, obviously there's, whether it's something I don't understand about the Chinese economy, or whether I'm just consuming, let's say, bad analysis and commentary from the sources that were telling me that this, impending, full scale economic blow up was coming. But really, I think the lesson I had, sort of the takeaway was, when you have a centrally controlled economy, very top down in many
Hmm.
ways, you can put things in slow motion, but that doesn't mean that they're not in motion.
Uh-huh.
So
Okay.
I
Okay.
kind of I kind of have maintained, this idea that China is structurally in trouble, at least from an economic perspective.
Hmm.
And whether it's the dependency on the property sector, the lack of domestic consumption, demographics problem, right? With rapidly aging population. And, there's some rumors that they've overstated their population by hundreds of millions in the census.
Oh,
And,
wow.
the whole, one child policy is not
Yep.
necessarily a sustainable thing for setting the foundation of a consumption driven economy decades into the future. Um, So, I mean, yeah, there's a lot of really major, let's say, headwinds to the Chinese economy. But again, you can open an op-ed in the FT and 2 years ago, do what I did and read about Evergrande, and then go and tell your friends and say, hey, the Chinese economy is about to collapse in a month, and you'll sound like the smartest guy in the room. And then a month goes by, and the Chinese economy doesn't crash, and then you say, okay, well, what the heck happened? Was I wrong, or what did I misunderstand? And so that was sort of me. Like I thought I understood what was happening in China better than I did. And I've realized that it doesn't mean that there aren't these structural headwinds to, let's say, the Chinese economic system, but they can pull a lot of strings to, let's say, kick the can down the road. Which, I mean, in many ways, it's what the U.S. does in a crisis, but in the way that in the 2008 financial crisis, where all of a sudden that you have these underlying tensions building up years and years and years, and then all of a sudden you have to address it very quickly.
Yeah.
I kind of get the feeling like officials in China have been well aware of this property sector bubble, and whether they've done a good job addressing that is maybe a different question, but they can kind of plan for their response over a longer time frame and drag out sort of the crisis in a way that that might happen in a much quicker time span in, let's say, in the US. And in many ways it reminds me of what we saw with Japan in the late 80s and 90s, where you have this huge debt and property bubble. And if you don't deleverage, actually Ray Dalio just had a piece that he wrote about this of, China basically needs a what he calls a beautiful deleveraging. Otherwise, they're going to face sort of decades of deflation, expedited by their demographic problems that Japan has faced.
Yeah, Japan's market's not really done anything since the 80s, right? It's just been kind of sideways for the last 40 years.
Yeah, I mean, you look at those charts and you're exactly right. You can draw a straight line from like 1989 to 2019 or 2020, and the stock market is at like the same level. So that's terrible. Yeah, it's absolutely terrible. Yeah, I don't know. I mean, I am not going to pretend like I know exactly what is going to happen with China, but there are, some very interesting ramifications. Like, you're looking at, I saw a headline earlier this week of, basically state banks in China are going to be selling U.S. treasuries to, let's say, defend the yuan because they're trying to boost domestic consumption. And, if the currency devalues a whole lot, that's going to make consumption a lot harder. And so, now you've got banks in China, they're selling off their U.S. Treasury holdings. And then, how does that ripple through the U.S. Treasury market at a time when, Janet Yellen has basically said that we're going to do, I think, $1.8 trillion of net issuance in the second half of 2023. So you're going to have this huge supply of treasuries. We've got quantitative tightening from the Federal Reserve and rate hikes, also adding pressure to the bond market. And then you've got, let's say the Fitch credit downgrade. You've got all of these factors that are putting a huge amount of pressure on the treasury market. And we've seen, long bonds have been complacent for like the last year and a half or whatever for so long during this rate hiking cycle. And now it kind of seems like they're starting to break. And yeah, again, I'm not going to pretend to be an expert on internal Chinese matters, but to me, it's really interesting as somebody who's made a point of not investing in China. It's really interesting for me to consider how that ripples through and impacts the broader financial system. And, for example, what does it do to the U.S. Treasury market? And then what sort of pressure does that risk off, environment? How does that affect tech stocks and the U.S. stock market generally, and real estate and inflation and sort of all that stuff?
There's just so many variables that it's almost impossible to predict with any sort of certainty. You can have ideas of what's likely to happen, but I mean, I think the thing that we learned from studying the markets is that it's all percentages and probabilities. It's more like quantum mechanics than it is hard physics.
That's right. Yeah. I mean, I totally agree with that. It's, you just have to be honest and try to give maybe probabilities as much as possible to the outcomes. But yeah, I mean, really what that comes down to is acknowledging that you don't know what you don't know, and hedging any opinion or outlook that you have accordingly. So, a lot of people are really long duration assets. Their home and stocks. They've got 70% of their 401k in the stock market. And how prepared are they for we've had interest rates falling for 40 years, which is a boon for financial assets, both real estate and the stock market. Are you prepared for maybe 40 years of a secular reverse in let's say interest rates, right? I mean, what if it's not unprecedented, but if we see basically treasury rates bounce off from the bottom of 2020 and 21 and then rise for several decades? I mean, what sort of headwind does that mean for most people, and are
Right.
people positioned for that? And back to your comment on the probabilities, most people have this probability weighted view of the world that's based on 40 years of falling interest rates, where you're saying, okay, well, the stock market averages 9% a year and it's done that for the last 4 decades. So I should expect 9% a year over the next 4 decades. And it's like, okay, and you're, prescribing 100% certainty to that outcome, when in reality, there's this other factor that, is maybe a big contributor, and that is falling interest rates over the last couple of decades. And if you're not accounting for that, you're going to be blindsided by that. So that's not me
Mhm.
saying to short the stock market or to panic, or but it just sort of a reminder of these risks and these way of thinking about managing risk. That is this probabilistic view, and considering, okay, I'm pretty all in on these like long duration assets, stocks and real
Right.
estate. Maybe I should diversify a little bit, and think about, what would it mean if interest rates, if 10-year yields stayed where they are or kept rising for the next 15 years, what would that mean for my portfolio? And thinking about that, I think that's a thing that I would
Mhm.
encourage a lot of people to seriously consider, especially as inflation risks, which seemed unprecedented in 2019 and for the decades before that, really sort of rear their head. I mean, I wrote a paper in 2020, basically saying that we were moving into a new secular era of sporadic inflation, and I didn't think we'd
Mhm.
hit 9%, but I thought over the next decade we would have consistent prints that were well above the sort of 2% target. And I started
Right.
trying to reposition my portfolio accordingly, which, as we've talked about, included some Russian stocks. But that was not that was not the entire
Right. Right.
hedging
Right.
plan. So
Yes. It could have been worse.
yeah, exactly.
How, going back to that lesson that you learned there, like, are you happy that you actually went through that? Because I find that a lot of people that make outsized risk bets without knowing what they don't know and then having them work out for the good tends to
Yeah.
be worse in the long run for their growth.
Yeah, I think that's well put, because I mean, you saw it a lot with like the Robinhood stock trading
Yeah.
frenzy, like 2020, 2021. You have a lot of people that, oh, I just bought this and it went up 50%. And then I bought this and it went up 20%. And it's, oh, stock trading is really easy. And you have no idea, like, it's like, yeah, you have no
You're
risk control. You're not hedging at all. You're going all in. You're doing, out of money.
in a historic bull market too.
Yeah, you actually have no idea what you're doing, or if you're like me, you're taking geopolitical risks that you didn't even realize
Yeah.
you were taking.
Oh yeah.
And so I would rather have had that blown up, early on in my adult life and career, than to have that blow up in 20 years from now, where I'm losing, maybe a huge chunk of my retirement account. In the big scheme of things, that loss has really no impact on me, because I'm young. I'm going to, most of my lifetime earnings are ahead of me, and I will make that
Mhm.
money back and I will reinvest it, hopefully better, because of that lesson. But
Exactly.
yeah, and kind of to my point of, you've had decades of structurally falling interest rates and subdued inflation. I mean, that's been a huge boon for asset prices. And you
Yeah.
have this sort of, I think Mike Green of, what is it, Simplify Funds now? He used to work at Logica, but he talks about this a lot, of like how the stock market has become this public good. We have so many
Mhm.
pension funds that are tied to the S&P 500, where they have, huge chunks of their investment in the US stock market. And you have, so many people that are just told, oh yeah, buy the S&P 500, it'll return 9% a year every year, and model out your retirement needs based on earning 9% a year in the stock market for 40 years. And the way he talks about it is like it's just really become a public good. It's like, is the stock market this tool for measuring risk and valuing companies, or is it just a way for everybody to fund their retirement? They're not necessarily compatible.
Right.
So yeah, I don't know. It's really interesting for me to think about some of those dynamics and wonder, for example, is the stock market become a public good? Or I think another way to put it is it too big? Is it too big to fail?
Right. At this point, yeah, if something happened to where the stock market did fail, I think we have much bigger problems than worrying about the stock market.
Right. But I mean, just think of it. I mean, I know there's so many of my
Yeah.
friends, graduated college, and it's like, yeah, I'm going to put 100% of my 401k in an S&P 500 index fund, and if
Yeah.
I get 9% a year, I'm going to have $3 million by the time I'm 65 or whatever, and that's their whole financial plan.
That was mine 10 years ago.
Right. And yeah, and you've got millions of Americans. I mean, you go to just like the generic, some sort of website giving out financial advice or whatever. I mean, the generic advice is basically to do that. And I'm not even saying not to do that, but I'm just really, my point is to be aware of what you're doing and why, and make sure you understand that risk, and don't just invest in Russia without understanding the geopolitical implications, or don't just only invest in the S&P 500 without understanding this kind of public good dynamic and the impact of structurally falling interest rates and subdued inflation, to get really technical about it.
Right. Last thing, because we're kind of coming up towards the end of time here. Last thing I want to ask you that is, as somebody who writes and analyzes things in the stock market, you mentioned when you're talking about reading about China and not knowing if you're getting bad analysis or not. Like, how do you spot that now? Like, how can readers spot bad analysis?
Oh, it's such a great question. Man, it'd be very easy to say almost all of it is bad analysis. I think
I mean,
I think I actually just finished. It's funny enough. I was reading "Skin in the Game" by Nassim Taleb,
mhm.
and he does not speak highly of journalists because
Yep,
I think he
yep,
called it the mother of all agency problems, with with journalists, because their whole thing is right to get you to click on the
right,
article and read it, and not necessarily they're not a fiduciary, right? And this is not somebody
right,
who
right.
is legally obligated to present you an unbiased or factual or even contextualized take on what's happening. And so I don't know, it's been really interesting to work on writing sort of financial news, because I really have this new appreciation for like how maybe quote unquote fake news works. Like
Mhm.
it's not explicitly, it can be explicitly lying to you, but it's not necessarily that. It's often like the context you choose to leave out, you know?
Right,
And
yes.
so like when I do a write up and we're talking about Evergrande in China, there's a million things you could touch on. And, by definition, you're making sort of an editorial decision of like, okay, we're going to include this and we're not going to include that. But, obviously you would need to account for all of those factors in a really unbiased reporting. So I don't know if I have a good answer for how to spot that. I mean, honestly, the biggest red flag to me is whenever people speak with too much confidence and too much certainty. I mean, if
That
somebody tells you exactly what's going to happen or how it's going to happen, I mean, anytime there's like, and it's so frustrating because that confidence is very attractive. When I listen
mhm.
to somebody who's so highly confident that they know what is going to happen, it's very appealing. It's like, yeah, I'm just going to outsource my thinking to him because he knows exactly what he's talking about. He knows way more than I do.
A lot of people follow Michael Burry.
Right. Exactly. Yeah. And you get, a lot of these charlatans that just make a business out of, telling people things with really high conviction.
If it's something you want to hear, then maybe you should question it. I think that may be the one way to look at it.
Right. Yeah, exactly. That sort of confirmation bias. So, I mean, I can just say personally, I don't think of myself as a journalist. I don't tell people I'm a writer. I think of myself as being an investor first, and then I
Mhm.
write a newsletter. And that's our way of trying to cover financial markets.
That's what I like about what I was reading that you've done is that it's analysis. It's not trying to predict. It's
Yeah.
this is what's going on. This is how it's affecting things right now. Like
Yeah.
it's up to you, the reader, to determine how to use that information.
I mean, yeah, I appreciate you saying that. And I mean, that's really been the hope, of like,
Hmm.
I find a lot of media and news to be kind of like condescending, where it's
Yeah.
like telling you what to think, and it's like, no, no, I'm capable of thinking for myself. Like I just,
Right.
like thank you for putting this on my radar and giving me some context. And so, I mean, we try to provide as much context as possible, but look, I mean, even we're limited. We make editorial trade-offs of like, I don't know if there's just not enough space to like cover this topic, or if we mention this, it's going to lead down a whole nother rabbit hole. And so, we make the same editorial trade-offs, but I'd like to think that we do it from a lens of we're investors and we're not journalists, and
Right.
we're I'm trying to communicate what I would want to know from every story to people who are reading the news, and
Hmm.
not necessarily just kind of like shoving our opinions down your throat. So yeah, I don't know. I mean, it's a really important question, but that agency problem is going to exist everywhere in media. And, really, okay, I'm going to get on a slight tangent here, but
Go ahead.
I think in this whole age of ChatGPT and AI, it's so important, more important than ever, to have personal brands that you follow and trust, because there's going to be
Hmm.
so much artificially generated content out there. Like, how do you, as a newsletter, it's something we ask ourselves all the time. Like, how do we, draw that distinction? I mean, if you're going to look at a list of what jobs were first to be replaced by ChatGPT, I think a
Hmm.
newsletter editor and copywriter would be like the first one.
Yep.
And so, to my point, like we've really thought a lot about like, okay, well, we have to be intentional and build a personal relationship with our audience. And the more sort of individual trust that you can build, I think that goes a long way. Um,
Yeah.
so we try to sign off different parts of the article, the newsletter, with who wrote what, and try every now and then we provide personal snippets and stuff like that, and you can read our bios on the website and all that good stuff. But we're really trying to build some context of how and why we see the world the way we do, and who we actually are as people, as opposed to just being some generic publication that could have been written by ChatGPT, as far as you know.
Yep.
So yeah, I don't know. I think in the coming years, I think those personal relationships and feeling like you have that trust with, let's say, the actual person producing the content that you're creating is going to be really important. I mean, and that would be one way to say why podcasts have
It
done so
is
great, right?
100% why.
Yeah,
The majority of people tune to podcasts to get their news now, and they do it because of that personal connection. They don't get
yeah.
that. You don't get that from a news anchor on CNN.
Exactly. Yeah. Because that anchor can, and to me, it's not even about CNN or Fox or whoever it is.
Yeah,
It's literally just that,
any of
it's
them.
a
Yeah.
brand. And like that anchor is going to get subbed out with somebody else. And, in an
Yep.
hour, a new anchor will be on. And it's like you're trusting the brand.
The whole school of
Yeah.
journalism is to be impassionate and just present the facts. But
Right.
people want that connection. They want to know the person that's talking to them.
Yeah, totally.
Yeah.
Yeah. So I think that's a huge value add. And really, I would say, unless it's a source that you've really come to trust over the years, you should probably be skeptical. But
Yeah.
I have a list of people that I follow very closely, and I say people, specifically, not necessarily publications, because these are individuals who I feel like I've learned to understand and trust. And I like hearing their opinions on things, and that's sort of how I hedge this agency problem in journalism. Of course, I read a lot of articles by
Hmm.
a lot of different journalists, but sometimes you kind of take it with a grain of salt. And then there are, of course, opinions that I trust more, and I add more weight to those.
Yeah. Sean, this has been one heck of a conversation. I thoroughly enjoyed chatting with you. We kind of went on many different tangents there, but I thought it was all applicable and better than the questions that I had drummed up beforehand. So I love it when that happens.
Yeah, I tend to do that. I tend to, as a warning to any other podcasts that I go on, I tend to jump around a lot.
Oh, I think the Investors Podcast should be giving you your own. I think you did
I
very
appreciate
well, and the ones I listened to you on, yeah, personable. You got the personality for it for sure.
it. Thank you. I appreciate it.
All right. Well, unfortunately, that does mean that we've come to the end of our time with Sean. And while we are sad to have to say goodbye, we are comforted by the fact that there is so much content at theinvestorspodcast.com from Sean and his team to comfort us on those lonely nights we reminisce about today's conversation. If you enjoyed this episode or now wondering what to do with the rest of your life, go check out our guest directory. You can see all the other amazing traders, financial writers, publicators, podcasters that we've had the pleasure of speaking with over the years. All those links will be in the episode description. We'll be back soon with another exciting episode. But until then, share this with your friends so we can become billionaires and Shawn can study us.
Well said.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.